of the major economic indicators. We have production, geopolitical, employment, growth, and inflation. These are the main categories. Now, production indicators are indicators that gives us insight into how production is doing in a country. Okay? These indicators are used by the central banks to see whether the country is being productive or not. So examples of production indicators are PMI, the Philly Fed index, etc. So central banks use these indicators to give them insight into whether a country is being productive or not. So in order to get an early estimation of what growth is like, central banks use these indicators, use production indicators such as the PMI and the Philly Fed index, to give them early insight as to what to expect for GDP. Now, geopolitical indicators. Now, these are non-economic things that can cause risk in the market. Now, example is changing government or wars. Now, employment. Now, examples of employment indicators are like non-farm payrolls, jobless claims, and the employment rate. Now, these indicators give you an understanding of how many persons are unemployed in an economy. Okay, so these indicators gives you an understanding of how many persons are unemployed, and for example, non-farm payrolls gives you an example as to how many jobs are being added to the workforce each month. So the central bank has to pay keen attention to employment indicators. Employment can be affected by low growth. So if we have low growth, this can cause an increase in unemployment. Okay, so if we have unemployment as a result of low growth, what the central bank will do is try and increase the money supply in the economy. So the central bank will try to increase the money supply in the economy in order to stir up production and employment. So more persons having access to loans and more money in the economy should increase demand and hence increase production. So when there's unemployment as a result of lack of growth, you may see the central bank lowering interest rates, or you may see the central bank implementing QE programs. This is quantitative easing, where the central bank pumps money into the economy. Also, unemployment can be caused by increased inflation. Now, this is when increased prices causes a decrease in demand, and decrease in demand results in a decrease in production, and if employers are not producing as much, then employers do not need as much employees. So this can cause unemployment, and I explain this further on in the course. So high inflation can cause unemployment, so the central bank has to keep keen focus on unemployment indicators, and this is one of the main reasons why indicators such as the employment rate and non-farm payrolls has such a huge impact on the market. Now, growth indicators. Now, an example of a growth indicator is GDP, which is the gross domestic product, and this is released every 3 months. Now, this tells us if the economy is growing or not. We want to see an increase in the GDP number. We want to see a constant increase in the GDP number, and this tells us that the economy is growing, because increasing GDP means increasing production, which is growth. And we also have inflation indicators. Now, an example of an inflation indicator is the CPI, and this is released every month. Now, the CPI is the Consumer Price Index and gives us insight into the rate of inflation in a country. So the central bank pays keen attention to CPI to always have an understanding of the level of inflation in a country. And inflation is how the cost of goods and services are moving. So if the cost of goods and services are increasing, we say we have increased inflation. And if the cost of goods and services are decreasing, we say we have decreasing inflation or decreased inflation. Okay? And in the next lecture, we'll be looking at tools for economic stability.